We're back this month for another finance bulletin with regular podcaster Mr. Kevin Saunders. Kevin is an expert in all things finance and borrowing for dentists up and down the UK. Today we're going to talk about what interest rates are doing, what we need to know when it comes to making our next borrowing decision, and also specifically discussing refinance and why there's been a little bit of a resurgence in terms of cases for practice finance experts out there. Looking forward to talk about all of those things and more in today's episode. Now then, Kevin, familiar face in the Dentist Invest podcast, back to talk about finance once again and all the things that we said on the tin in the intro to this podcast and more. But before we talk about that, I just want to say that it was really fun to have you along to our event the other weekend, Business of Dentistry, which was really cool, and there was certainly a great turnout, which is amazing. So yeah, fun to have you there. Maybe we'll get you on the stage next time.
Hi, James. Yeah, no, it was a great event actually. So different from the bigger shows, which I think some of which have lost their way a little bit and are a bit stale. It was just nice to get so many people in the room that could give advice to dentists, and also for dentists to be able to come around and talk to us and not feel intimidated by talking to us. The stands, it was tables rather than stands, so it felt more intimate, is what I'm trying to say. And I think the dentist got a lot out of that.
There we go. Well, we're definitely trying to bring the energy and bring fun and mix it up a little bit and not talk about clinical stuff because that's what every other event under the sun does. So we want to talk about the business side of dentistry and how it can be ethical and have great businesses too. And actually, those two things can be exactly the same thing when you know how. So yeah, definitely a little bit of a different flavor on it. And actually, on that note, we're going to bring in even more of a different flavor still with the next event, which is coming up in November, which is Entrepreneur's Den, where we'll be having exactly the same stuff that everybody knows and loves about the events that we currently run. Plus, on top of that, we're going to have dental startups, dental industry startups, young entrepreneurs, well, not specifically young, any age of entrepreneurs who run and have set up these businesses, these new businesses, and they're going to be pitching to a live audience of a ton of dentists who will be able to witness all the thrills and spills of Dragon's Den, crossed with X Factor as well, actually, I should mention, all at the same time, and some dragons there who are going to really grill them on the viability of their business. So looking forward to that one. We're definitely going to make a theatrical event out of it and have some fun with it, and that's going to be really cool. So yeah, coming up in November. But yeah, back to what we were talking about initially on this podcast, and certainly the aim of the game and the name of this podcast, which is to talk about finance specifically. And maybe a good place to begin would be on the front of the of interest rates, Kevin, because from what I understand, the Bank of England recently held interest rates.
Yes, I went back actually and listened to the podcast we did in February, which feels like a completely different world now. Back then, I mentioned that we'd had four cuts in 2025 and two cuts to interest rates in 2024, to the base rate specifically. And it looked like we were going to get a further cut this year. Since then, because of the matters happening around the world, everything's changed. I've sat in on a lot of chief economist briefs from the banks recently, and they're all saying the same thing. No matter what the scenario and what happens in the Middle East, the Bank of England, all of their forecasts offer rate rises now. So it seems to be a question of, are we going to get one or three rate rises? And they're talking about that happening by mid 2027. Almost feels like the phony war at the moment. Feels like the calm before the storm because they're holding the interest rates, and we can only hope that if matters can settle down, then maybe it'll just be one rate rise, and that wouldn't be too bad after all. But anyway, yeah, that's where we stand at the moment.
Even as far ahead as 2027, they're predicting that rates might rise. Surely so much can change since then.
Well, it can, and as you've seen from February, things have really changed in the last few months. But at the moment, if nothing changes, depends on how long things drag on in the Middle East with Iran. But it could be three rate rises by mid 2027, or it could just be one. If things are sorted out quickly, you're more likely to just have one rate rise. But these are just forecasts. As we always say, nobody knows, crystal ball territory. And let's hope for a good outcome on this.
Yeah, indeed. And for those who don't know, the main reason the Bank of England, well, one of the main reasons the Bank of England Bank of England do this, is to tame the inflation beast. So that's definitely a big factor which determines what their next move is. And inflation is it's kind of stubborn, but it is lower than what it was in years gone by. So certainly they'd look for that to start to decrease a little bit before they might think about rate decreases. Certainly, reducing interest rates for sure. So they're definitely watching that one avidly. So it's always a case of watch this space as ever.
I mean, we've had a real education out of this, haven't we, as well? Because who would have thought that oil prices would affect clothes manufacturers and pretty much everything in life seems to be affected by this. So yeah, inflation is expected to rise, hence so is the base rate.
There we go. And let's bring that back to dentistry. Kevin, what does that mean for us on our borrowing? What should each demographic of dentists should be what should they be looking out for? Or is it just blanket kind of not advice? We don't like that word because we don't want to cross that line, but certainly blanket things that we should be aware of. Or how does that look? What are you saying to your clients?
Yeah, and the reason for doing this now is we were saying that we're in choppy waters. We don't know what's going to happen going forwards in terms of the rate rises. So why not consider refinance? Anyone that's got any existing finance should really be looking at it. So who are those people who should be considering that? Anyone that took a loan out, and I'm going to give you two events to make it easier than just stating years here. Anyone who took a loan out between, say, the credit crunch and COVID, which is roughly sort of 2008 to 2020, were probably paying a higher margin with the bank. So whatever base rate was doing, their margin's probably 3.5% over base. That's a ballpark figure. It could be either way, either side of that. But rates are much lower now, or the margin's much lower. So anyone in that bracket should have a look at this. Anyone who's set a practice up over the last 10 years or so and maybe was paying 4.5% over base, they've now got an established practice. So we can jump back in and get it valued. It's got goodwill value, and we can put them on a lower rate, along with a lower rate rather. So anyone that has too much short-term finance, and short-term finance is great. You need it for equipment, etc. But sometimes it's too easy to obtain, and people tend to take too much of it and have high monthly payments. So we're helping quite a few people at the moment lift all of that debt and put it onto a mid-term, and by that I mean the sort of 15 to 20-year loans, and that brings repayments down massively, and it can make thousands of pounds of difference a month in some cases. So that's definitely one to look at. Anyone who is relocating, extending their practice, kitting out surgeries, expanding, buying further practices. What we tend to do now is someone approaches us for finance for whatever the reason, we'll automatically look at any existing finance and look and see if refinance is an option on that as well. So, sorry, James, you were going to say?
No, no, I thought you were finished. Is all. I'm listening.
Kind, yeah. So obviously against that, we look at the cost of refinance because obviously what we don't want to do is lead a client down a path that turns out to be horrendously expensive. So there are fees to consider, such as valuation and legal fees, early repayment charges on fixed rates, or sometimes just variable rate loans have them in some of the legacy loans. So we need to price all that in as well, which is what we do with clients. And if it's not to their advantage, we wouldn't take a client down that route. But the banks have various products out there that can help with this. Some banks have products with no facility fees. Some banks have products with no valuation or security fees. Literally, it's just an unsecured loan. The rate is cheaper than it was back in the day. All the client will need to do is put the facility fee on the loan and make sure they've got a life policy to cover the debt. On top of that, we've mentioned before, we've got these loans with a larger amount of it on interest only and a smaller amount repaying over a short period of, say, 5 years. And that allows us to get a really cheap rate on those loans, again, ballpark about 1.5% over base rate. So that can outweigh some of the upfront costs sometimes in refinance. So the other thing to consider is interest rate versus term. And again, we've mentioned that the banks have released lots of new products recently, and one of which is an extension to goodwill loans to 20 years. So if the rate goes up slightly, sometimes it's still better to do that because the monthly payment is lower and it's all about cash flow. So for example, if you took 500,000 at, let's say, an all-in rate, base rate and a margin of 6% over the standard 50 years, your monthly cost is 4,219. If the bank added 0.5% onto that and termed it over 20 years, then there's a monthly saving of about £500 a month. And to my mind, that's better steered towards overpaying your mortgage, your residential mortgage. And I had a conversation with a client about that this morning, and basically said, your plan going forward now should be to repay your residential mortgage because there's no tax relief on the interest on mortgages. So if we can get the commercial debt as low as possible and then steer the money into repaying the personal debt.
Nice. That's some wizardry right there.
Yep.
It's all about thinking about the strategy, I guess, really. Okay, cool. So these are, I mean, it's like all of these things. There's always so much. I always think this to myself whenever you talk about finance. I'm like, man, there's so much depth to it, and it's why I guess it can make sense to get a pair of eyes on it. Not just someone who's just gonna, I guess, flog you a product per se, but also just have a conversation with you about like what your plans are long term, and even revisiting these sorts of things because it's free to ask, right?
Oh, definitely. Yeah, but we can overview this for clients and feedback to them. As I said earlier, we're not afraid to tell clients, actually, you're better off just leaving your finance as it is. It's all about how it's structured and feeding back a range of options. So we'll feed everything back to the client and they can make a decision. I mean, and as I said before, the banks are lending in very different ways. So often there'll be 3 or 4 different options as to how we could possibly structure this, different terms, different products. There's no right or wrong answer here, but at the end of it, if you can reduce your monthly payments and steer that money into to building your personal wealth, then that can't be a bad thing.
Understood. And is it as simple as interest rates go up, therefore finance rates go up as well, or not really?
Well, I guess if you've got a fixed rate, then you're fine. Anyone on the variable rates, if base rate goes up, then yes, their monthly cost of borrowing will go up with it as well. But yeah, let's put that in perspective because rates have reduced quite a long way from where they were at the start of 2024. As we said, we've had 6 rate cuts. So if we had 1 or 2 now, it wouldn't be the end of the world. It's just always nice to have a cheaper rate.
Nice. And I know from a previous podcast, people on this podcast may have listened to those, and we've got a whole series of different podcasts that talk about how can I say this, all sorts of different factors and the nuance of finance, the difference between equipment finance, the difference between practice finance, everything along those lines. So shout out those episodes. We definitely won't repeat ourselves from those today. So really what this episode is, Kevin, in a nutshell, is a bulletin to say, basically, guys, here's the things you need to be aware of. Here's the things that may have changed, and here is what is out there by way of new products and everything along those lines. We've covered people who, I guess, already have finance, Kevin, but what about first-time buyers? What would you be saying to them at the minute?
Yeah, so before I answer that, I would just say what I really want to encourage anyone with existing finance to do is just reach out and check their finance arrangements out. Because so many people just sit there with the finance they took out 10 years ago, not realizing that they could be saving a lot of money. So I guess that was the motivation behind this podcast. We know that we're going to have inflation, rate rises, so why not review your existing debt? Yeah.
Well,
So
that's it. And just to quickly touch on that, it's like, okay, cool. Obviously it's impossible to predict, but if at present it looks like something's going to rise, I guess their interest rates are going to rise. Then I guess it could represent a window of opportunity, whilst they are where they are, to get things reviewed and then hopefully locked in on a fixed rate, which is much more favourable. Or at the very least, no matter where that pans out or whether that goes up or down, you've made some sort of meaningful gain in the meantime because you have already reduced your rates. So yeah, just something to consider. But yes, back to what we were saying a second ago. First time buyers.
Yeah. So first time buyers, we're back to the conversation we've had previously, which is should you wait for the cheapest rate? And the answer is no, not really, because rates go up and down. If you start buying a practice today because the rates are low, by the time the practice completes, which is often 9 months, rates might have gone up, and they're going to fluctuate and go up and down over the term of the loan. You're borrowing for 15 years, not for the next year. So while it's helpful for rates to be cheap when you first buy, I don't think it's the reason not to buy right now. So first time buyers should definitely still look at buying a practice if the right practice comes up. I think I mentioned in the last podcast that first time buyers have gone a little bit quiet, but they seem to have come back more now. I think that they're realizing there's no point waiting this out. The world carries on, doesn't it? And you and I said if there's a good business opportunity there to buy a great practice, then you shouldn't be waiting for base rate to go down to 3%.
Absolutely, 100%. Kevin, thanks so much for sharing everything that you said in the podcast today. If anybody wants to reach out to you, get in touch off the back of anything that we said today, how are they best off finding you?
Yep. So the best email address is info@saroma.co.uk. That one reaches both my colleague Dan Fearon and I, or they can find us on our webpage, the Saroma Finance webpage, or the mobile number is 0780 144 0622.